Hello everyone. Hey guys. Welcome to Infinite Floating Stocks. I am Venkat, and in this session I'm going to talk about option chain analysis. I repeat, in this session I'm going to explain you how to look at option chain analysis table. Okay? I mean options chain table. Okay? So all right, let's get started. So here are the contents for today's session. I'm going to talk about what is option chain analysis and what is strike price, what is spot price, and what's the difference between strike price and spot price. And I'm gonna show you what are premiums and what is premium, and I mean how can you view them, where can you view them. Okay, I'm gonna show I'm gonna talk about premiums. Okay, and as I explained, I have told you that I'm gonna explain you about in the money, out of the money, and at the money in later sessions. Okay, so this is a session where I'm going to talk about ITM, ATM, and OTM, which are nothing but in the money, at the money, and out of the money. Okay, so don't worry, don't get confused. I'm gonna simplify everything. I'm gonna explain you in very detailed format. Okay, so and yes, uh, I'll also introduce you about OI. Okay, OI is nothing but open interest. Okay, so I'm going to talk about OI and change in OI, and yes, IV and also volumes, etc. So all these things are will be there in option chain table. Okay, so I'm gonna explain you uh, each and everything which is present in option chain table. Okay, so and also let's talk about how do we use OI and change in OI of OTMs as support and resistance. Okay, so these are all the contents for today's session. All right, so first thing is, what is option chain analysis? Okay, option chain analysis. Any idea? What do you think? What do you know about option chain analysis? All right, no issues. All right, okay. I'm gonna talk about it. I'll be explaining it I'm gonna explain it in very simpler format. Okay, I'm gonna talk about it in very simple words so that you'll directly get it into your head. Okay, all right, okay. So here is the simplest definition for option chain analysis. If you're not understanding the definition, also no worries, no worries. Okay, don't worry. I'm gonna explain you again. Okay, so an option chain is also known as option matrix. Why should we call it as option matrix? Simple. Wait, I will show you the table. So this is the option chain table. Okay, so it's very simple. To open this option chain table, you just need to go to Google and type in option chain. See, go to Google, type in option chain. Option chain, that's it. Go to Google, type in option change, click on enter. Click on this first link, which is nothing but option chain equity derivatives NSE, National Stock Exchange. This first link. So, I mean, the URL is www.1.nseindia.com option underscore chain. Okay. So, this is a URL for the option chain table. Click on that link and you will get this table. Okay. So, this table is known as option chain table. Few people call it as option chain matrix or option matrix. Okay, because it looks like a table. Tables are nothing but matrices. I think most of the people here know what is a matrix. I mean, we use it to study about matrices and different properties of matrices in our intermediate, in our plus 2. Okay, so yeah, because it's a table, because it looks like a table, so we call it as option matrix. That's it. No other logic behind why do we call it as option matrix. Okay, it's pretty simple because it looks like a table, and most of the data here is consolidated into a table, so we call it as option matrix. That's it. Okay, so this is how the option chain table looks like, and it's pretty simple to find it. Okay, so I know most of the guys don't know how to open an options chain table. It's pretty simple. Just go to Google, type option chain and click on first link, which is www.1.nscindia.com. Okay. So after clicking on the first link, after clicking on the first link, this table will directly get opened, which is nothing but option chain data or option chain matrix, option matrix. Okay. So here you will find different numbers. Okay. So don't get threatened by seeing all these different numbers here. Okay. So I'm going to brief about uh, role of each and every number here. And also I'm going to talk about OI, change in OI, volume, IV, what is LTP, net change, bid price, and all these things. Okay. I'm going to explain you everything. Why few fields are yellowish and why few fields are white in color. Okay. I'm going to explain you about their importance as well. Okay. All right. So here's a formal definition for option chain analysis, which is nothing but an option chain, as also known as option matrix, is a listing of all available option contracts. Okay. What does the table include? It's nothing but it's a list of, okay, all available option contracts. What are contracts? You already know. I have explained you about option contracts in our previous session, saying that uh, I have explained you about option contracts using farmer and shop owner example. Okay. Farmer signing an option contract saying that he'll be selling the vegetables on 31st of December for 5,000. Okay. So if he signs option contract, he need to pay some premium to get the right. If he is having the right, then he can sell, sell those vegetable at the current market price on 31st of December. Okay. So if you're unclear with this example, if you didn't get about, if you're facing any difficulties in understanding this farmer and shopkeeper example, no worries. Ping me, talk to me, message me. I'll be sending you out the recorded sessions of previous session so that you can watch it again. And yes, you can watch it again and clear all your doubts. If you are not getting after watching it again also, don't worry, call me up. I'll be explaining you with few other examples as well. Okay. So option contract is pretty simple. Option chain is also known as option matrix. Okay. And it is nothing but it's a list of all available option contracts. Okay. Both puts and calls for a given security is nothing but stock or index. Okay. Puts and calls, I already told you what are puts and what are calls. Okay. Put is nothing but it's a type of option. It's a type of option contract. There are two types of option contracts. I already introduced you guys to those two type of option contracts. They are nothing but call option and put option. Okay. So in that table, in option matrix or in option chain data, you'll be able to find all the available contracts data. Both it includes, the table includes puts and calls data. Okay. And it shows about puts, calls, strike prices, and pricing information for single underlying asset within a given expiration date. Okay. This is a formal definition for option chain analysis. What all the data uh, consolidates into a table, and that table can be called as option chain data or option matrix. Okay. So this is a formal definition for it. Don't worry, I'm going to explain you once we're onto the table in next few minutes. Okay. So what is a strike price? Strike price is very simple. Okay. Strike price is nothing but look at this middle column. Look at this middle column in the table. It is written that strike price. Okay. Strike price is nothing but all these are strike prices. Okay. Now see, 13,950, 14,000, 14,050, 14,100, 14,150, 14,200. All these are strike prices. Okay. For example, let's check what's the current price of Nifty 50. Okay. Now see, uh, option chain. This is option chain data For what? For Nifty 50, because I have selected Nifty here. Nifty. You can also check for Nifty IT and also no. Okay. You should be checking for Nifty, or you should be checking for Nifty Bank Nifty. Okay. So let's go with Nifty first. Okay. So I have selected Nifty here, and let's select the date as, I mean, expiry date. I already told you that contracts expires. Okay. So let's select the latest expiry, which is 31st of December 2020. Okay. So for before 31st of December, uh, I mean, on 31st of December, which is last Thursday of December. So on that day, all this option contracts ends. Okay, so there won't be any value for all these contracts after 31st of December, because 31st of December is the expiration day, and all the strike prices and all the premiums won't be having any value after 31st of December, because 31st of December is the expiration day. Okay, so now imagine. So imagine that you have made some price action analysis, and I mean, just imagine that you are expecting that Nifty 50 will cross 14,000 before 31st of December. Okay, imagine that you made some price action analysis, and you are estimating that Nifty 50 will cross 14,000 before 31st of December. Okay, so what's the current price? Let's look at here. Current price is 13,926. Okay, the current price of Nifty 50 is 13,926, and you are estimating that I mean, the Nifty 50 will cross 14,000 before 31st of December. Where is 14,000? This is 14,000. Okay, all right, it's accurate. So this is 14,000. So you are estimating that market will cross 14,000 before 31st of December. Okay, so it's nothing but you're bullish. Nothing but you are bullish, right? If you're bullish, what can you do? You can buy call or sell put. Yes, you can buy call or sell put. Okay, for that, what can you do? Oh, I'm so sorry. For that, what can you do? It's simple. Just go to our Opstra. Opstra is nothing but, I mean, you can calculate your profit and loss and all those details in Opstra. Okay, so this is Opstra. Opstra.defineedge.com strategy builder. It's a strategy builder. We use it to learn. Okay, so just click on Nifty here, because we are dealing with Nifty here, and we are estimating that Nifty 50 will cross 14,000 before 31st of December. Okay, for that, what can you do? Select Nifty here and select options here, and 31st December is our expiry, and option strike. It shows that option strike. What should be your strike price? It's simply 14,000. It's simply 14,000, because you are estimating that Nifty will cross 14,000 before 31st of December. So you need to buy 14,000 call. I already told you, you're bullish here. Okay. When you are bullish, you need to buy call or sell put. Okay. Let's talk about buying call scenario. Okay. So I have selected Nifty and I have selected options, and 31st December is the expiry I'm talking about. And I'm estimating that Nifty 50 will cross 14,000 before 31st of December. For that, I am bullish. So if I am bullish, I need to buy call or sell put. So here I'm buying call. This is CE is nothing but call European, which is nothing but call. Okay. So I am buying call. So I have selected buy here, and I'm selecting lots, which is one lot. Okay. So I'll add position. Okay. After clicking on add position, you will get payoff diagram. This is payoff chart. Okay. Nothing but see, before 31st of December, if I mean before 31st of December, if Nifty is crossing 14,000, see, all these are your profits. If Nifty is crossing 14,000, or if it crosses 14,300, or if it crosses 14,500, whatever may be the upper limit after 14,000, all those are your profits. Look at your profits. If Nifty is at 14,240 rupees, then your profits will be 14,625. If Nifty is going to 14,555 before 31st of December, then look at your profits. Your profits will be 38,250 rupees. Okay. So this payoff chart will give you an overview. Okay. So it will tell you what can happen after taking your positions. Okay. So you should be analyzing your positions in Opstra by adding your positions here. Okay. Now see, uh, if it doesn't happen, let's consider negative scenario. Imagine that uh, before 31st of December, Nifty didn't cross 14,000. Okay. Imagine it ended up, instead of going up, imagine that it went down till 13,451. Okay. What can happen? Look at your loss. Your loss is only 3,375 rupees. Okay. Your loss is limited here. Now see, even if it go down to 13,000, or if even it is going down to zero, from current market price, even if the Nifty goes down to zero, you won't be facing loss more than 3,375. Okay, that's the advantage about option buying. See, I just told you about option buying. Buying is nothing but I have clicked on buy here and I have buyed call here. Okay, so in option buying, your loss is limited and your profit is unlimited. Now see, after crossing 14,000, if market goes to 15,000 or 16 or 17, 20 or 80,000 also, the more the market moves up, the more profits you get. Okay, in options buying, your profits are unlimited and your loss is limited. Imagine before 31st of December, if Nifty 50 if Nifty 50 didn't go to, didn't cross 14,000, imagine that it just went till 14,000, 14,000 or 13,880 or 13,900. Imagine that it just stayed there. Okay. So what can happen? You'll be facing only a loss of 3,375 rupees. Okay. Even if it staying at 13,999 also, you'll be facing the loss, which is only 3,375. Even it is coming down to 12,000 or 10,000 or 8,000, even the Nifty falls to 5,000 before 31st of December, you are not gonna lose more than 3,375 rupees, because you are an option buyer and your loss is pretty limited here and your profit is unlimited here. Okay. uh, it's very simple. When you're dealing with options, you just need to have a view. If you're bullish, buy calls. If you're bearish, buy puts. Okay. All right. That's all about option buying scenario. Let's get with, I'll talk about option selling scenario now. Okay. For same example, let's consider same example. Imagine that I'm estimating Nifty 50 will fall down. Oh, no, 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 no. Same view. Okay. Imagine that I am bullish. Okay. I'm estimating that Nifty 50 will cross 14,000 before 31st of December. Okay. So what can I do if I'm bullish? I can buy call or sell put. Okay. Now I have explained about buying call scenario. And let me explain about buy call or sell put. Okay. Let's sell put. I have selected PE and I'm clicking on sell here and I'm dealing with one lot and I am adding my position. Okay. So let's look at payoff diagram or payoff chart. Now look at here. If the market crosses 14,000, look at your profit. It's only 8,325. Even if it going to 14,300 or 14,500 or 14,700 or 15, 20, 30 or 80K. Okay. We cannot estimate the upper limit, right? So if even if the market is going up till 80K or 44K, something else, okay, your profit, you won't get profit more than 8,325 rupees if you're selling puts. Okay. This is about selling scenario, option selling scenario. Here your profit is limited and and your loss is unlimited. Look at the loss. Instead, imagine that the market didn't go, didn't touch 14,000 or didn't go beyond 14,000. Imagine that it came down to 13,600. Okay. So what can happen if it coming down to 13,600? Look at your loss. It's minus 20K. Okay. Imagine if it's not going till 13,600. Imagine that it went to 13,200. Look at your loss, minus 51,525 rupees. Okay. So in option selling scenario, loss is unlimited, but profit is limited. Okay. So same example. Let's look. I'm talking about same example. Yes, you are bullish and you are estimating that Nifty will cross 14,000 before 31st of December. Okay, 31st of December is your expiration day, and you are estimating that Nifty will cross 14,000 before 31st of December. Okay, in that scenario, if you are bullish, you can buy call or sell put. Okay, if you are buying call, profits are unlimited, loss is limited. If you are instead of buying calls, you can sell put as well. If you are selling put, your profit is limited and loss is unlimited because option buyer gets the right. If you're having the right, I mean, you can reduce your loss. I mean, that's what I told, right? Option buying, if you're a buyer, you will get the right. If you're having the right, you can reduce the loss and increase the profit. Increasing profit is nothing but option buyer will have unlimited profits and limited loss. Okay. If you're an option seller, you'll get the obligation. If you get the obligation, you cannot do anything. Okay. So in that scenario, your profits are pretty limited and your losses are unlimited. Okay. Instead, if market is going, I mean, in option selling scenario, if your view is correct, if market is going beyond 14,000, if it's going to 15,000 or some 16 or some 13, I mean 15 or 16 or 20K as well, you're not gonna get more profits. Okay, you'll be getting only defined profit, which is nothing but 8,325 rupees. Okay, but in negative scenario, imagine that your view went wrong. Nifty didn't cross 14,000 before 31st of December. Instead, imagine that it went to 13,400. Okay, look at P&L report. It shows that if that happens, you will get 31,500 loss. Okay, imagine that it instead of going upward, imagine that because of some negative news, imagine that Nifty went down till 13,000 or 12,000, or let's imagine it went till 13,100. Okay, look at the loss. Loss is minus 58,950 rupees. Okay, so in option selling scenario, loss is unlimited and profits are limited. Okay, so this is all about when you are bullish. Okay, so this is nothing but strike price here. Strike price, I have selected 14,000 because I'm estimating that market will go beyond 14,000 before 31st of December. Okay, so that price is called strike price here. Let's go to our table. Look at our table. Where is 14,000? Yes, this is 14,000. 14,000 is our strike price. If you are estimating that Nifty will cross 14,150 before 31st of December, yes, you can do the same. Just go and type in 14,150 here. And if you're bullish, you can buy call or sell put and look at your payoff diagram and just go with it. Or else, imagine that you are estimating that Nifty will cross 14,150 before 7th of January. Okay, before, imagine here you have got more time. Okay, imagine you are estimating that market will cross, Nifty will cross 14,150 before 7th of January or some 14th of January. Okay, so here you are bullish. You can buy call or sell put. Let's buy call. 14,100, 7th Jan. Okay, so let's buy call, add position. So see, your profits are unlimited here. If market is crossing 14,150 before 7th of January, then see, look at your profits. The more the market moves up, the more profits you get. Profits are unlimited here in option buying scenario. Instead, if it's not crossing 14,150 before 31st, I mean before 7th of January, then look at your loss. Your loss is 7,766 only. Even if it is going down to zero, even if the Nifty falls down to 2,000 or 5,000 or zero, something else below 13,000, you're gonna get the same loss, which is limited, which is 7,766 only. Okay, so you just need to get the view right. That's it. Okay, so this is all about strike prices. Okay, all right. If you're bearish, it's just opposite. Okay, if you are bearish, you need to buy put or sell call. I repeat, if you're bullish, buy call or sell put. If you're bearish, buy put or sell call. Okay, so whatever you do, you just need to go to Opstra and you need to build the strategy here. Whatever you do, you just need to go to Opstra, and if you're working on Bank Nifty, select Bank Nifty, or if you're dealing with Nifty, select Nifty, and if you're dealing with options, select options contract here. And whatever view is, if your view is before 31st of December, select 31st of December. If your view is 7th of January, then select 7th of January, whatever it is, and select the strike price. If you're estimating that Nifty gonna cross 14,000 before 7th of January, then that means you are bullish. Then if you're bullish, you need to buy call or sell put. Okay, click on add positions, look at payoff chart, and just decide. Okay, so yes, I'm going to talk about payoff diagrams and how to use this Opstra and all those details in upcoming sessions. Okay, so let's move forward. All right, what is strike price? Now I'm estimating, I'm expecting that most of the people present in this lecture are pretty clear with what is strike price. Okay, it's very simple. Strike price is nothing but the price which you have, I mean the price which you are expecting that gonna that is achievable. Okay, so strike price is very simple. Strike price is nothing but, I mean, in our example, strike price is 14,000, which is nothing but you guys are expecting that Nifty will cross 14,000 before 31st of December. Okay, in our scenario, it's nothing. Strike price is nothing but a price uh, on which we are making an option contract, or we are buying some option, or we are selling some option. Okay, estimating that, I mean, Nifty will make a move till that point or beyond that point. Okay, or yeah, it's pretty simple. Strike price is nothing but a price on which we are signing, or on which we are buying or selling some option. We are making on which we are making some option contract. Okay, so that price is nothing but strike price. I mean, if you are bullish, buy call or sell put. If you are bearish, you need to buy put or sell call. It's as simple as that. Okay. After buying puts or selling puts, or after buying calls or selling calls, you just need to go to Opstra and select your strike price, and select options, select buy or sell, and look at payoff diagram, and just have a clear view that how much you're gonna lose if your analysis is wrong, or how much you're gonna gain if your analysis is pretty good. Okay, so you need to have that idea. So for that idea, you need to use Opstra, and you need to use that Opstra and get a glance of your positions. Okay, what can happen if market goes down, or what can happen if it's going up. So what can happen, I mean, you'll get a glance where the market is moving. Is it moving according to you, or is it moving against you? If it's moving against you, what can happen? How much loss you can get? If it's moving in your direction, how much did it move, and how much profits you're gonna get? Okay, so you'll get all those things if you are looking at payoff diagrams using Opstra. Okay, all right, guys, that's all about strike price. So what is spot price? Spot price is nothing but it's a strike price. Pretty simple. but few people call it as spot price. We call it as a spot price. Spot price is nothing but its last traded price. Nothing but in our scenario, here it is 13,300. I mean 13,926, right? So 13,926 is closer to 13,000. Okay, let's look at Nifty options. Let's refresh. Okay, so 13,900 is the nearest price for, I mean, nearest strike price for 13,926. Okay, so we can call this 13,900 as spot price. Okay, so in our in this example, 13,900 is spot price, and 13,850, 800, 750, 700, 650, and 13,950, 14,000, 14,050, 14,100. All these are strike prices, and the price which is closer to the strike can be called as spot price. Okay, so look at this thing. Nifty current price is 13,926, which is near to 13,000, which is near to 13,900. So 13,900 is spot price, and remaining all are strike prices. Okay, so it's pretty simple. That's all about spot price and strike prices. Okay, so what is premium? Premium is nothing but you already know what is a premium. Premium is just like a token amount which you gonna pay to get the right. Okay, I already explained you this with building example, car insurance company example, and also I have already explained you this using Tata Motors stock example, and also yeah, I have explained you about premiums using farmer and shop owner example as well. Okay, if you have any doubts or if you're unclear with what is premium or token amount or advanced amount, you can go back to those sessions, you can watch them again. If you are not understanding, call me, hit me up, I'm going to explain you those things again. Okay, so premium is nothing but it's a token amount. So where can you find premiums in option chain table? It's pretty simple. Let's go back to the table. So this is table. So what is premium? Premium is nothing but change in Y, volumes, IV, LTP. This LTP is our premium column. Okay, so LTP is nothing but last traded price. Okay, LTP is nothing but last traded price. So all these are premiums. See, if you are bullish, what I told, if you are bullish and you are estimating that Nifty will cross 14,000 before 31st of December, then you need to pay how much? 44.50 as a premium amount, as a token amount, as an advanced amount. Okay, so for 40, if you are estimating that market will cross 14,000 before 31st of December, that means you are bullish. If you are bullish, you need to buy call or sell put. Okay, if you want to, if you want to have the right, if you want to have the right of buy, I mean right to buy, then you need to pay the premium. So what's the premium that you need to pay? It's nothing but 14.50 is the premium that you need to pay. Okay, so this is nothing but calls. Look at this table. Table says that all this data towards the left side of the table is related to calls, and all the data which is related to right side of the table is related to puts. Okay, the strike price is common for calls and puts, but all the remaining data towards the left side of the table is related to calls, and all the data which is related to right side of the table is puts. Okay, so if you're estimating that Nifty will cross 14,000 before 31st of December, then if uh, that means you are bullish. If you are bullish, you can buy call or sell put. Okay, if you want to buy the call, you need to pay the premium, because if you're buying the call, it's nothing but you are buying option. You are an option buyer. If you are an options buyer, you need to pay the premium. If you pay the premium, you will get the right. Okay, so if you are an option buyer, if you want to buy the call, then 44.50 is a premium that you need to pay. Okay, so 44.50 is nothing but last traded price. That's nothing but premium amount of last traded price of a call. Because you are bullish, you need to buy the call. So you need to select calls column, and that 44.50 is the premium amount that you need to pay. Or imagine that you are estimating that Nifty will cross 13,950 before 31st of December. So for that, that means you are bullish. If you are bullish, you need to buy call. If you want to get the right, if you want to buy call, then you need to pay 67.10 rupees as a premium. Okay. So this column is nothing but a premium column, which is nothing but last traded price. This is for calls, and last traded price. This is for puts. Okay. That's the premium you need to buy. All right. Let's look at Opstra. You'll get more clear. So imagine that you're dealing with Nifty and options and 31st of December and 14,000. Okay. So you're estimating that Nifty will cross 14,000 before 31st of December. Okay. For that, you need to buy call. Okay. CE buy call. So click on add positions. So click on add position. Look at this option price. Option price. What is option price? It's 45. Look at the table. It's saying that 44.50, pretty close, right? So that's the premium you need to pay. 45 is the premium you need to pay. Okay. So let's go to Zerodha stockbroker. Let's type in 14,000 Nifty. So all right, it's already added to my watch list. So look at this thing. Nifty December 14,000 call. C is nothing but call. So if you are bullish, you need to buy call. Okay. So all right, look at the amount required, which is nothing but 3,300 3,337 rupees required, because I already explained you that option contracts are standardized. While buying option contracts and future contracts, or while selling options contract or future contracts, we only deal in standardized quantities. Okay, nothing but you won't get loose quantities. Okay, so here you need to buy 75 quantities or multiples of 75. You want to get, it's like wholesaler. Okay. So in retail shop you will get in loose quantities. In wholesale shop you will get only in standardized quantities. It's like that. Options and future contracts are standardized. Okay, they are like wholesaler, so you will be dealing with only in uh, only in some standardized quantities. You won't get loose quantities here. So if you are bullish, and if you're estimating that Nifty will cross 14,000 before 31st of December, then just select Nifty December 14,000 call. I am buying here. I am an option buyer here. For that, I need to pay the premium. Premium is nothing but, look at this NFO here. 44.50 is a premium that I'm gonna buy. Okay, so 44.50 into 75. 44.5 into 75. Nothing but 3,337. Okay, it's nothing but 3,337.5 rupees you need to have to buy that call. It's showing the same here, 3,337.50. It's nothing but 44.50 into 75 quantities. If it's 150 quantities, you need to have 6,675 rupees. Okay, so it's like that. Just go to Opstra. Now see, after paying 3,337.75 rupees, if your view goes right, look at your profits. If your view goes wrong, you'll be losing only 3,375 rupees that you have paid. Okay, so you'll be losing only amount which you have paid. But if your views goes right, then look at the profit. Profits are unlimited here. Okay, so that's about premiums. Okay, so what is ITM, ATM, OTM? Nothing but in the money, at the money, out of the money. Pretty simple. So ITM is nothing but in the money, ATM is nothing but at the money, NTM is nothing but near the money, OTM is nothing but out of the money. I repeat, ITM in the money, ATM at the money, NTM near the money, OTM out of the money. Okay. So in the money are nothing but yellow fields. Yellow fields in option chain table, and out of the money are nothing but white fields in option chain table. Let's go to the table. So this is the table. So this is the table. Now see, you're able to see yellow screen. I mean yellow table, white table, and also white table, and also yellow table. Okay. So this side is about calls, and this side is right side is about puts. Okay. So I already told you. I already written in that slide said that yellow fields are in the money. This is in the money for call. This is in the money for put. So that this white side towards the call is out of the money for calls, and this white side towards the right, I mean towards the right side of the screen is nothing but puts out of the money. So all this is, I'm sorry, so all this white area towards the right side of the table is out of the money for puts. Okay. So all this white, I mean all this data which is present in white area towards the left end of the screen is nothing but out of the money data for calls. Okay. So this yellow fields towards left end of the screen in the table is nothing but in the money data for calls. Okay. So all the data which is present in this yellow fields towards right end of the screen or right end of the table is nothing but in the money data for puts. Okay. So it's pretty simple. If it's yellow, it's in the money for calls. And if it's yellow, it's in the money for puts. Okay. If it's white, it's nothing but out of the money for calls. If it is towards left side of the table. If the white area, if the data is in white area towards the right side of the table, is nothing but out of the money for puts. Okay. So just remember. So just remember, white area is out of the money and yellow area is in the money. Okay. So that's it. So ITM in the money, at the money, near the money, out of the money. So I have explained about in the money and out of the money. At the money is nothing but last traded price. Okay. At the money is nothing but this money, 13,900. 13,900 is nothing but at the money. Okay. 13,950 or 13,900 is at the money. At the money is nothing but which is closer to last traded price. Now see, Nifty 50 is at 13,926. This is last traded price of Nifty 50. Okay. So the strike price, which is closer to 13,926 is at the money. So closer is nothing but 13,900 or 13,950. So this is nothing but at the money. And strikes which are closer to that strike is nothing but near the money, and which are far are called, I mean, if strike 13,400 is 13,400 call is chosen, then that's in the money. Or if the strike 14,450 put is chosen, then it's in the money. If strike 13,000 put is chosen, then that is out of the money. Or if strike 13,350 call is chosen, then it's out of the money. Okay. I'm pretty sure you guys are very clear with white area, yellow area, and yellow areas are called in the money, white areas are called out of the money. Okay. So strike price, same. Spot price is nothing but pretty close to last traded price of Nifty. Okay. Similarly, at the money also is nothing but a spot price or spot strike, nothing but which is closer to last traded price of Nifty or Bank Nifty, whatever the stock or index you choose. Okay. Near the money is nothing but strike prices which are near to last traded price. I mean, if Nifty is trading at 13,926, then 13,950 and 13,900 will be the near the money strikes or at the money. They're pretty simple. Okay. There is no difference between them. Okay. Now, yeah, I just explained you about all these things, guys. So ITM is nothing but in the money. And let's look at what is ITM, ATM, and OTM for call option. Okay. All right. Just give me a second. Just give me a second. All right, guys. So let's talk about what is in the money, at the money, and out of the money for call options. Okay. So for call options, what I told, you need to consider the data which is towards left side of the table. Okay. Let's go to the table. All right. So left side of the table is nothing but data which is related to calls. Okay. So all this is related to calls. I mean, all this data is related to calls, and all this data which is towards the right side of the table is related to puts. Okay. Now say what is at the money strike? At the money strike is nothing but 13,900 or 13,950. All these two strikes are called at the money strikes or spot prices. Okay. So 13,850, 13,800, 13,750, 13,700. All these are strike prices. And you can also call 13,900 and 13,950 as strike price, or you can also call them as spot price. Okay. Why do you call it as spot price? Because it's closer to last traded price of Nifty. Okay. If you select Bank Nifty here, now tell me what is the spot price? Pretty simple. Spot price is 31,300 or 31,400. Okay. Now tell me what is strike price. Strike price is nothing but 31,200 or 31,100 or 31,000, 30,900, 30,800, 30,700. All these are strike prices. All these are strike prices. Okay. Spot price is nothing but the price which is closer to last traded price of Bank Nifty here. Okay. So 31,300 or 31,400 are spot prices, and remaining all are strike prices. Okay. So you can also call 31,300 and 31,400 as strike prices as well. No issues. Few people call them as strike and few people call them as spot price. No, there is no difference. Okay. And now see what is at the money here. At the money is nothing but the strike price which is closer to last traded price of Bank Nifty here, which is nothing but 31,300 and 31,400. So these two are at the money strike prices. Okay. So let's look at what is in the money call. I already told you what is in the money. In the money is yellow field. Okay. Yellow field. In the money is yellow field. This is in the money, yellow field. This is in the money, yellow field. Okay. Now see, I am telling, let's go to, now look at this PPT. What is in the money for calls? In the money for call is nothing but if selected strike price is below spot price, then we call that strike price as ITM strike. Simple, pretty simple. Okay. If selected strike price is below spot price is at the money strike or last traded price strike. Okay. So then we call that strike as ITM strike. ITM is in the money strike. Okay. Now see, what is the last traded price of Bank Nifty? Bank Nifty. Nifty Bank. Okay. Now see, last traded price of Bank Nifty is 31,349. Okay. So 31,349, which is closer to 31,300 and 31,400. Okay. So these two strikes are at the money strikes. Okay. So what is in the money strike? In the money strike is nothing but yellow field. In the money strike is nothing but all these are in the money strikes, because all these are lower than 31,300 and 31,400. So all these are in the money strike for calls. Okay. And what is out of the money strike for call? Out of the money strike is nothing but white area. And out of the money strikes are nothing but strikes which are greater than last traded price or greater than at the money strikes. Okay. Now see, 31,500, 31,600 or 32,000, 32,100. All these are out of the money strikes for calls. Okay. Because it's white area, so we call it as out of the money. And strikes, if we choose strikes which are greater than at the money strike, then we call it as out of the money strike for calls. Okay. For in the money strikes, you need to choose strikes which are lower than at the money, which is nothing but last traded price strike. Okay. So if the strike price, if the selected strike price is below spot price, then we call it as ITM strike. If the selected strike price is above spot price, then we call it as out of the money strike. I already explained you. Okay. Above the spot price is nothing but above the last traded price of Nifty Bank. Okay. I have selected Nifty Bank option chain data. So if the selected strike price is above the spot price, then we call it as OTM strike. OTM is nothing but out of the money. Out of the money is nothing but white area in the table. Okay. We are dealing with calls. So calls is nothing but left end of the table, left side of the table. So this is left side of the table, nothing but calls data. And if it's in yellow field, it's out of in the money. If it's white field, then it is called out of the money. Okay. So this is spot price or at the money strike, which is 31,300 or 31,400. Okay. So this is at the money strike, and strikes which are greater than at the money and which are belonging to white area, then then those strikes can be called as out of the money call strikes. Okay. So if the strikes which are lower than at the money strike or last traded price, then we call all the strikes as in the money call strikes. Okay. It's that simple. So in the money, at the money or near the money is nothing but if the selected strike price is close to last traded price. I already showed you. Okay. If the selected strike price is close to last traded price, then we call that strike as at the money or near the money strike price. Okay. Pretty simple. Now let's look at what is at ITM, ATM, OTM strike for put option. Put option, pretty simple, just the opposite. Okay. Let's go to the table. Now see, 31,300 and 31,400 are at the money strikes. Okay, at the money strikes for both calls and at the money strikes for puts as well. Okay, now see, if you select 30,600 put, this is put, and imagine that you have selected 30,800. Sorry, imagine that you have selected 30,800 put, which is nothing but 30,800 and put, which is belonging to white area. If it's white area, it's out of the money. Okay. So 30,800 put is nothing but out of the money. Imagine you have selected 32,600 put. See, this is put and you have selected 32,600. Nothing but it is belonging to yellow area. If it is belonging to yellow area, then that is nothing but that is in the money strike. Okay. I repeat, 31,300 and 31,400 are at the money strikes. And if you select 30,200 call, just go like this. Okay. If you select 30,400, if you select 30,400 strike, if you select 30,400 call, that is belonging to LA area is nothing but in the money call strike. If you select 32,600 call, it is belonging to white area, so it is out of the money call strike. Okay. Now, if you select 30,000 or 29,900 put, this is put, and here is 29,900, which is belonging to white area is nothing but out of the money put strike. Okay. Now, if you select 32,900 put, this is put, and this is 32,900. Oh, this is 32,900 put, which is belonging to yellow area, which is nothing but in the money put strike. Okay. So it's pretty simple. Let's go through the formal definition of ITM, ATM, OTM of put option. Okay. If the selected price is above the spot price, then we call it as ITM strike. If the selected price is below the spot price, then we call it as OTM strike. Okay. If the selected price is close to last traded price, then we call that strike price as ATM strike or NTM strike. NTM is nothing but near the money strike. Okay. That's what I have explained you. See, let's look at ITM definition. If the selected strike price is above the spot price. Okay. So above the spot price. Now see, I have selected 31,900. Imagine that I have selected 31,900 put. This is put. This is 31,900, which is nothing but that 31,900 is above the ATM, and towards put. It's falling in yellow area. Yellow area is nothing but in the money put strike. Look at the PPT. It's above the spot price, which is nothing but above the at the money strike price. Then we call it as in the money. Okay. So if the selected price is below the spot price, if it falls in white area, and if it towards put side, then we call that strike price as OTM put strike. Okay, so pretty simple. All right. What is OI? Change in OI and IV and volume. Okay, simple. OI is nothing but open interest. Okay, so this is a formal definition of OI, which is nothing but open interest is the total number of derivative contracts, such as options or futures, that have not been settled for an asset. Okay, so the total open interest does not count and total every buy and total every sell contract. I know most of the people didn't get the definition. No worries. Don't We are not gonna write an examination by learning the definitions here. Okay, so don't worry about the definition. I just put it here for formality. Okay. Anyway, I'm gonna explain that. I'm gonna explain you about the OI in very simpler words when we are on to the option chain table. Okay. So that's the formal definition about option chain. And change in OI is nothing but change in open interest from last trading session. Don't worry. Let's go to table. So this is option chain table. And where is OI? So this is OI and this is change in OI. Okay. So you can find OI and change in OI towards both sides. Look at this OI and change in OI. Okay. Now see, OI is nothing but uh, if the value is 3,000, 3,73,450, that means there are 3,73,000 people waiting here to buy the strike or to sell the strike. Okay, so let's consider this scenario. If OI is telling that 3,63,275 here, nothing but there are 3,63,275 orders are waiting here to get executed at 30,200 put strike. Okay, again, I'm going to talk with different example. See, if this is 46,125, if the value of OI, see this is OI, if the value of OI is 46,125, that means there are 46,125 orders are waiting to get executed, to get placed at 32,000 strike price. 32,000 put. So people gonna place orders or people gonna execute their orders at 32,200 put. Okay, so that's the count of orders. Okay, that is open interest. Okay, now let's consider this scenario. It's 5,40,225. Nothing but 5,40,225 orders are waiting to get executed. At what strike price? At 32,500 call side, because I have selected OI of call data. This is data related to calls. Okay, so when I'm selecting OI towards left side of the table, that is nothing but the data is related to calls. Okay, so let's look at this thing. 8,85,125 people, not people, orders. 8,85,125 orders are ready to get executed at 32,000 strike, 32,000 call strike. Okay, so OI is nothing but open interest. If the value is 2,54,650 here, that means 2,54,650 strikes or orders, orders. 2,54,650 orders are ready to get executed at 30,000 call. Okay, last example. Okay, so let's consider this one. If the value of OI is 1,27,975, that means 1,27,925 orders are getting ready to get executed at 30,800 call strike price. Okay, so nothing but people are already placed their orders. That OI data, OI count shows that those many orders are waiting to get executed at that strike price. For example, if Bank Nifty reaches 30,800, all these orders will get executed when the price reaches 30,800. So imagine if the price reaches 32,100, all this 1,81,100 orders will get executed if the market reaches 32,100. Okay, imagine the 6,27,850 orders are waiting here. They'll get executed when market reaches 29,500. Okay, nothing but all these people are expecting that market will come down and hit 29,500. Okay, so imagine here there are uh, 10 lakhs 94,775 orders are waiting to get executed at 29,900. Okay, so those many orders are waiting to get executed at 29,900. Okay, if the market reaches there, all those orders will get executed. Okay, so this OI data tells that those many contracts or those many orders are getting ready to get executed when the market reaches that strike price. Okay, so change in OI is nothing but this OI and change in OI, those values get changed for every minute. Okay, they will get changed for every minute or 2 minutes. Okay, nothing but people like you, me, and all the other retail traders will have different views. Everyone will have different views. Few people expect that market will go up, few people will expect that market will go down, etc. Okay, so few people choose 30,900 strike, few people choose 30,200 strike, or few people choose 32,100 call strike, or few people choose 33,200 put strike, whatever may be the strike. So there are a lot many people with different opinions, lot many people choose different strikes. Okay, depending upon their orders, these values will get changed. I mean, the OI value and the change in OI will get changed for every 1 or 2 minutes. Okay, so uh, if the value is 3,37,775, that means 3,37,775 orders are getting ready to get executed when the market reaches 30,500. Okay, so that's all about OI and change in OI. They change a lot because there are a lot many people trading in the market and lot many people having different opinions and lot many people will choose different strikes and they place orders. Okay, and they'll imagine that market will come to, I mean, just like our opinion, which I have said, that Nifty gonna cross 14,000, or that's a general opinion. That's an example. Okay, don't get go and buy 14,000 call. Okay, so that's just an example. So now see, if people are expecting that Nifty will cross 14,000 before 31st of December, then you can buy call. Nothing but let's select Nifty here. Nifty. Okay, see 14,000. How many? See 57 lakh 77,475 orders are ready to get executed when market reaches 14,000. Okay, that means there are 57 lakh 57 lakh 77,475 orders are getting ready to get executed at I mean will execute when market reaches 14,000. That means lot many people are what can I say? They lot many people are also expecting like us. Okay, so I mean, like I told, the value of OI and the value of change in OI will change for every 1 or 2 minutes. So it varies from minute to minute. Lot many people will drop off from their orders, or lot many people will expect the same and place their orders. So because of that pressure, value of OI and change in OI will changes for every 1 or 2 minutes. Okay, so that's all about. If the value is 13 lakh 59,525, that means those many orders are getting ready to get executed when market reaches 13,500. Okay, all right. So This is the formal definition for it. Just ignore. If you're able to understand it, then it's well and better. If you're not able to understand, also no problem. Anyway, you know what is OI and what is change in OI. I have just explained you about OI and change in OI in option chain table. Okay. So if the value is big, that means lot many orders are getting ready to get executed when market reaches that strike price. Okay. All right. Now, what is OI change? Okay, it's the same. So, what is implied volatility? Implied volatility. IV is nothing but implied volatility. Is nothing but is an estimate of future volatility of underlying stock based on option prices. Again, this is a formal definition. Don't get worried about this definition. If you're not understanding the definition, also no worries. I'm going to explain it in with pretty simple examples when we are onto the table. Okay. So IV is nothing but IV is nothing but implied volatility is nothing but it's an estimated it's an estimate of future volatility of underlying stock based on option prices. Okay. So generally IV increases ahead of upcoming announcement or an event, and it tends to decrease after the announcement or event. For example, if there are some elections, then IV will increase. IV is nothing but implied volatility. Okay. So that's the announcement refers to that event, elections or something else. Okay. All right. I'm going to explain you about IV. IV is nothing but implied volatility is nothing but, for example, if this is 23 point, I mean, IV is nothing but implied volatility, which tells you that with how much speed the premiums can move towards upward or downward. That's it. In simpler world, in simpler words, IV is nothing but implied volatility, which tells you that with how much speed, I repeat, implied volatility tells you that with how much speed a premium can move towards upward or move towards downward. It's just tell you that. So in our table, this is IV. This is IV and this is IV. So this IV value is towards put sides. And if the IV value is towards the left side of the table, then that IV belongs to calls. And different strikes will have different OI, different change in OI, different volumes, different IV, different premiums. Okay. All those varies minute to minute or second to second. Okay. So I'm going to talk about IV, implied volatility, in upcoming sessions. I'm going to talk about IV and I'm going to talk about option Greeks in detail in upcoming sessions. Okay. So don't worry about it. I'm going to explain you in detail in upcoming sessions. So this is the final content for today's session, which is regarding how do we use OI, change in OI of OTMs as support and resistance. Pretty simple. All right, only one slide left. Now see, let's look at this thing. What's the, oh, all right, let's go to PPT. Now see, look at that. Look at the heading. How do we use OI or change in OI of OTM? OTM is nothing but out of the money. Out of the money is nothing but white field. White field in the chart, in the table. Okay. So see, this is white field. Now see, here it's having 24 lakh, 24 lakh orders. Here we are having 36 lakh orders. Now see, what's the highest here? 42 lakh orders is the highest, but it's very far from the current market price. Okay, so let's choose uh, highest number of orders, highest number of OI, which is closer to current market price, which is nothing but 36 lakh. 36 lakh is belonging to 13,800. So 13,800. So that can act as support. 13,800. So 13,800 can act as support here because we have lot many orders which are ready to get executed when the market reaches there. Okay. Now see, OTM is nothing but out of the money strike and which is towards call. And let's see. See here we have 17 lakh and 57 lakh. Oh my God. 57 lakh orders. Any other? No, there is no larger value than 57 lakh. So 57 lakh orders are getting ready to get executed at 14,000. So 14,000 can act as resistance. Okay. So this is how we use OI to draw support or resistance level. Okay. So the strike price, which is having largest OI towards put side, can be used as support, and the largest OI value of out of the money towards call side can be used as resistance. I repeat, I repeat. Let's select Bank Nifty for a change. See, selected Bank Nifty, came down. This is ATM strikes. So let's select more value in OI. So where is more value? 37 lakh, 33 lakh, 34 lakh. Oh my God, 73 lakh. This is highest here, which is closer to ATM. So 73 lakh, 200 and 600. What's the strike price? 31,000. So Bank Nifty 31,000 can be a support. 31,000. So this can be the support according to option chain data. And what's the resistance? Resistance can be, I mean, you need to select the value from white area only, from out of the money area. Okay. For drawing support and resistance using option chain data. Okay. Now let's consider towards call side, out of the money call data. Now see 34 lakh, 97 lakh. Oh my God. And is there any value greater than 97 lakh closer to our ATM strike? No, no, right? This is 88 lakh, but it's very far from ATM. Okay. From at the money strike. So 97 lakh is the largest value of OI, which is closer to our ATM, which is not, which is at 31,500 strike. So 31,500. So this 31,500 can act as resistance area, and this 30,000, sorry, what's it? 31,000 can act as support area. See, seriously, it worked. Look at this. Market opened here, went up, took support, went up. Okay, so that's how you can draw support and resistance using option data as well. So pretty simple. You just need to consider highest OI near to your ATM strike price. Okay, highest OI of OTM. OTM is nothing but out of the money. Out of the money is nothing but white area in the table. Okay, this white area is OTM of put. This white area is OTM of calls. Okay, so you need to select highest value in the OI in the white areas of the table. So highest OI is 73. Okay, 73 lakh. Sorry, 7 lakh 32,000 here. Okay, and 7 lakh 37,000, 32,000 there. So that cannot act as support. And for resistance, 97 lakhs. Sorry, 9 lakh 71,300. Okay, so this is the highest value in OI towards call side in out of the money area. So that value can act as resistance. So I have drawn them here. So that can be good support and resistance. And for Nifty, this can be good support and resistance. Okay, that's how you need to be drawing support and resistances using option chain data. See, that's what I have written. Highest value in OI of OTM strike of call can act as good resistance. I repeat, highest value in OI of OTM strike of call can act as good resistance. Let's go to the table. See, highest value 9,71,300 is highest value in the OTM strike of call can act as resistance. What's that? 31,500. 31,500. This is 31,500. Okay, so that is acting as resistance. Okay, so highest value in OI of OTM strike of put can act as good support. What's it? Highest value in OI of OTM strike of put can act as good support. Highest value in OI is 7,32,000 towards put of out of the money. So what's that strike? 31,000. So 31,000 here acting as support. That's what I have written. Okay. So I repeat, highest value in OI of OTM strike of call can act as good resistance, and highest value of OI of OTM strike of put. OTM is nothing but out of the money, which is nothing but white area in the table. Okay. towards the port. If it's towards the port of highest OI, then it can act as support. If it's towards the call of OTM strike, which is nothing but white area in the table, if it is having highest OI, and if it's towards the call side, then it can act as good resistance. Okay. And the second highest value in OI of OTM strike of call can act as second best resistance. Okay. So second highest value in OI of OTM strike of put can act as second best support and resistance. Okay. I'm expecting that you guys are very good with how to draw support resistance using option chain data, using open interest. Okay. You just need to consider data which is in white area, nothing but out of the money. You need to consider highest OI towards the put side and lowest OI towards the call side. If the highest OI towards the put side, then that strike can be then that strike can act as support. If the highest OI towards the call side, then that strike can act as resistance. I repeat, you need to have highest OI in out of the money fields, which are nothing but white fields. If the highest OI, if the highest open interest value is towards put side, then that can act as support. If the highest OI is towards call side in white area, in out of the money area, then that strike can act as resistance. Okay. So, all right, that's it for today. I'm expecting that you guys enjoyed this session, and I'm expecting that you guys got everything which was taught till now. Okay. I'm expecting that you guys are pretty clear with all the things with all the things which I have explained till now. Okay. So we'll see you in next session. All right, guys. Please like this video and subscribe to our YouTube channel. Thank you. Thanks a lot. Thank you, everyone.